Welcome to the Mentor Podcast, where the most highly motivated entrepreneurs come to get their weekly dose of financial stability with host Ron LeGrand, as well as other nationally recognized thought leaders who will teach you how to get, grow, and protect your wealth.
Hello, everybody. Welcome to another edition of thementorpodcast.com. My guest today is Gian Pazzia. Say it.
Pazzia.
Pazzia. Thank you. He's dealing with that name all his life here in the States. He probably spells it every day for somebody. So our subject is going to be cost segregation. And this particular podcast can save you a bunch of money that you don't need to spend to IRS if you listen to this man. Because I've had this done, which he doesn't even know. And I got about $150,000 deduction on my 3 commercial buildings where my office is. So take notes on this one because it probably applies to you. And if it doesn't, it will soon if you're in Planet Ron and actually decide to do something. So tell us what you do and, your experience, and then tell us stuff that we need to do to get these deductions that I don't know how much, probably 90% of the people in this country are just not getting because they don't know about it.
Yeah, thanks, Ron. So basically what I do is cost segregation studies, and it's funny, it's a tax strategy, but typically the people that do cost segregation studies aren't tax people, they're engineers, and that's my background. I'm a structural engineer by schooling, and I just fell into this trade 25 plus years ago. And back then, it was a strategy that really only the major Fortune 500 companies were taking advantage of. And there's a number of reasons for that, but today there's a lot more talent that does cost segregation studies and offers it to the small to medium market here. And what cost segregation is, it's a way for real estate investors to pay less tax by speeding up how fast they write off parts of the building. And normally the tax rules say that you can write off your building over 27 and a half years if it's residential, but for commercial properties, it's 39 years, right? But not everything in the building lasts that long. And so that's the premise for cost segregation studies. The tax rules say that some of the stuff in the building, because it doesn't last as long, stuff like vinyl flooring, the cabinetry, appliances, things like an asphalt driveway, they're not going to last as long as the building itself. And so a cost segregation study breaks down that property into different pieces, and you get to write off a lot more of those costs in year one. And so you get a bigger tax deduction right away, which means you keep more of your money and you can use that to reinvest in other things. The example, kind of putting it into numbers that I like to use, for somebody maybe buying a single family rental home for maybe $270,000. I'm going to use a number that will make sense in a minute. Normally, if it's a rental home you bought for $270,000, and let's assume all of that is the building and none of that is land, right? You would get to depreciate right off $10,000 a year for 27 years. That's the normal way you write it off. But with a cost seg study, as much as, let's call it 20% of that can be written off in year one. And so just do the numbers there. That's $54,000 that you're writing off in year one instead of $10,000. So that's a big, huge jump in how much in tax deductions you get. And so, it's, for a lot of sophisticated real estate investors, it's just part of the strategy. And every property that they purchase gets a cost segregation study because the numbers are so big.
Okay, tell us what kind of things you separate from the building and you put them on accelerated scale. Some are 5 years, some are 3 years.
Yeah. So the tax rules can be a little confusing and tricky, but normally for residential rental properties, you're depreciating components over 5 years. If it's considered personal property, things outside the building that are considered land improvements would depreciate or write off over 15 years. So inside the building, you're looking at things like ceiling fans, things like the carpeting, stuff that the infrastructure that supports the appliances. So if you have dishwashers, there's piping that goes to those dishwashers and electrical wiring inside the walls. A cost segregation study is literally going to quantify and measure how much piping and wiring there are to things like the refrigerator, the washer and dryer, et cetera, and put a value to it. And then, outside of the building, pretty much everything you see outside the walls of the building that's affixed to the land can be depreciated over 15 years. So we're talking about even the landscaping, the concrete walkways, sidewalks, asphalt driveways. Sometimes you got lighting out there. And that, like I said, is over 15 years. And some of your listeners may have heard of this rule called bonus depreciation, and that allows you to write even more of it off right away. So instead of 15 years under the current rules, you get what's called bonus depreciation, where you don't even have to write those off over 15 years. It's even quicker.
So, of course, the downside is when you get ready to sell, that all has to be recaptured unless you do a 1031 exchange. And regardless of whether you're going to keep it long-term or short-term, it's a lot of money that's going to go in your pocket. So you do houses as well as commercial buildings?
Yeah, that's right. That's right. So we are one of the largest cost segregation companies in the country, more certified cost seg professionals than anyone else, with offices from coast to coast. And we started 25 years ago, and we deal with a lot of major real estate groups, Fortune 500 companies that hire us to do this for them. But we, back in 2016, created a software tool that allows investors buying properties, single family rental homes for as low as $150,000 to be able to do this themselves at a price that makes sense. And so, yes, we do through that software product, a lot of these for those types of investors.
Do they even go to the site to do these, or they just go online?
So when we're doing a full-blown cost engineering cost segregation study for, let's say, a $10 million office building or 5 million, whatever the cost is, yes, we're going on site. We're measuring everything. We're photographing things. We're talking to the owners, understanding, what improvements might have been made, and really capturing everything that's in there. When we're talking about our software for the smaller residential properties, that's shifted to the owner, right? And they're going to be doing that. And our software it's like TurboTax for cost segregation. It only takes 10 minutes to use. But the point I'm trying to make is, when you're doing a full-blown engineering study, yes, you have to go there. The dollars are much more significant. You want a third-party professional doing that for you, for sure.
Okay, so it works on rental houses. Does it apply to residences or not?
Oh, I see. So
Where you live?
it has to be an investment property that's income producing, right? That's
That
the
makes
tax
sense.
rules. Yeah, so you can take depreciation only when it's income producing. So your home doesn't count.
And on top of that, I was told by someone that there's tax as of sometime last year, I think, there's tax credits, which means dollar for dollar is a dollar you don't give the IRS on anything that's energy related. What do you know about that?
Yeah, there's a number of incentives and credits out there. There's some at the state level. There's one at the federal level called the Section 45L tax credit. That's the code section in the tax code. And that one you get up to $5,000 if the building or the unit is considered energy efficient. And so we work with a lot of multifamily developers, that are in certain states where oftentimes they don't even have to do anything kind of above the normal building code to qualify for this $5,000 credit per unit. Yeah, to qualify, it's not like a prescriptive thing where you have to install this and this thing and that thing and you qualify. You actually have to do these energy model kind of studies to see
So
if it meets
we're
that
talking
criteria.
about a tax credit here, not a tax deduction.
Yes,
Okay.
that's correct.
Like central heat and air conditioning. For every one of those I install in rental properties, then that's a tax credit, right?
Correct.
And how far back can I go on that?
Yeah, with tax credits, you can only go back 3 years. That's the
Mhm.
statute of limitations
Okay.
for amending tax returns.
So name some of the things that I would um, write off. Air conditioners, of course. What else is considered energy efficient?
Well, the stuff that we deal with, as far as these credits go, the kinds of things that impact uh, the calculation that determines if you get this 45L tax credit would be HVAC, the types of windows that you use, um, uh, the insulation that's in the walls, etc. And so if you meet that criteria, you get this credit. It's up to $5,000. Now you might be talking, Ron, about some other incentives outside of the 45L credit that allow you, there's so many of them out there. So it'd be lying if I told you I knew and could keep track of all of them in all the different states.
Well, I'd like to get it square in my mind. I know you can uh, use central heat and air. I imagine you could use new windows, maybe even a new roof. I'm trying to think of anything that's energy efficient. Is there such a list anywhere of that? It must be.
Well, there is a website, I'll tell you, that lists out all the different incentives, and it's DSIRE. Uh, it sounds like desire, which a lot of people type in the wrong website and they get to a place that, an X-rated website, but it's not. It's
I would imagine.
DSIRE, and it's a nonprofit that lists out all the different state and local energy incentives, and you can kind of put your state in. You can put in what kind of project you're working on, and then you'll see uh, a dozen plus different things to look at.
Okay. How much does it cost to do a house?
For cost seg. Yeah,
Yeah.
so it's currently on our software, it's $450.
Hmm.
And yeah, I mean that's a huge discount when you look at doing a full-blown study. We typically charge five to $10,000 when we're looking at and having to go out to a property and do a full-blown engineering analysis.
Okay. So you make the list by visiting the property, and then what? You just hand that report to your CPA?
Yeah, that's right. So when you get a cost segregation study, it's going to be a report that, like I said, breaks the building down into, call it 300 different pieces, all the way down to the wiring for certain appliances. But then we summarize it into different categories. And you'll get maybe 25, 30 major building categories, including the roof, the windows, the doors, things like the driveways and the flooring. And yeah, that report is categorized by the different tax lives. So which ones are depreciated over 5, 7, 15, or 27 and a half years. That's what your CPA needs to report on the tax return. And from there, yeah.
Is this applicable to rehabbers, buy, fix, and resell within the year, or is this just applicable to investors who don't sell within the
Yeah,
year?
good question. You mentioned earlier, when you sell the property, there's a tax rule that says you have to pay recapture tax. And so if you're going to flip a property, you buy it and sell it in a year, and you're planning to do that for cash, okay, it doesn't make sense to do a cost segregation study, because you're going to get a bunch of tax savings in year one, and then you pay this recapture tax in year two when you sell, which essentially negates the benefit. However,
Unless you go watch my lesson on how to avoid that. By the way, if you're watching this, go to ronsgoldclub.com and become a member, which is 99 bucks a month, and go to the section on training. And there's another section on resources, and there's one on training. And in the training section, there's about an hour and 15-minute video of exchanging one house into 3 houses. That is, you've got to look at that. That's called 4 LLCs. Write that down, the number 4 LLCs, and pull it up, and you'll understand how you can literally cash out of your properties and not recapture the depreciation and quadruple the size of your empire every time you do one. You're not going to understand it until it's clearly explained to you at least 3 times, would be my best guess. But literally, you better go look at it, because you can build a fortune in a hurry by not doing what everybody else does. And that's give all your money to the IRS. And it's your responsibility to not give money to the IRS, legally, of course. And you're going to grow a whole lot faster when you're not giving the IRS 25-30% of your money you get every year. Anyway, what are the main questions here that I've missed here that we need to get in this podcast? Can you think of?
Well, there's some strategies out there. There's I don't know if your listeners are familiar with the short-term rental loophole strategy. That is that something that you're familiar with, Ron?
I don't think so, no.
Yeah, so with short-term rentals, okay, and let me take a step back. So one of the reasons why sometimes investors may not benefit from cost segregation is if they're considered a passive investor, right? So if you're a doctor, right, you got a full-time job running your medical practice, and you go invest in rental homes, you're getting a lot of income here from your medical practice. Say it's $1 million of income, right? You might be able to do a cost seg and generate a lot of paper losses on your real estate, but you're not allowed to use those deductions from your real estate against your, what I'll call, active income from your normal trade or business, right? So there's a rule out there that doesn't allow you to do that unless you meet what's called the real estate professional tax status, which is tricky. It's not the easiest thing to meet that hurdle, right? When you're a doctor or a lawyer and you got a full-time job. And so here's where the short-term rental loophole comes in, okay? For short-term rentals, the way the tax rules are written, those have different rules than normal residential rental properties that are depreciated over 27 and a half years. Short-term rentals under the tax rules, they consider that more like a hotel, right?
Yeah.
And in hotels and short-term rentals have to be depreciated over 39 years, right? So it's just this different category, okay? But once you're in that category, that activity is not considered passive. Okay, so now if you're a doctor and you have non-passive income from your medical practice and you are investing in short-term rental properties that are also not considered passive, you can meet the thresholds much easier to make that a non-passive activity. In those cases, there's a strategy, and it's called the short-term rental loophole, that people are able to buy those properties and use those deductions against their active income. So very good strategy that's out there. There's some other strategies that involve cost segregation. One of them that I think is one of the best strategies, I would say, is when your spouse, let's say you're a doctor, right? And
Mhm.
you don't want to buy short-term rental properties, okay? There's still a way that you can benefit from cost segregation against your active income from your medical practice. And here's the strategy. If you're married to a real estate professional and you file jointly, right? You get to net everything together. So in order for your spouse to be considered a real estate professional, doctor and wife buy, call it 5, 6, 7 properties. If the wife is managing those properties and spending 750 hours a year or more managing those properties, then, and you file jointly, now all of a sudden, all of those deductions from the real estate, think of doing cost seg on all of them, can be used against the doctor's active income. So it's a very powerful strategy. It's got to be the right situation, but a lot of investors don't know about it, but it's a very legitimate rule that's in the tax code.
Mhm.
And those that are able to capitalize on that, it's a good thing.
Yeah. All right. Okay, one more time. What should I have asked you that I haven't asked you up to this point?
Yeah. So I mean, I do have an offer for the listeners.
Okay.
We're offering any listeners to this podcast a 25% discount on the use of our software. It's called the Residential Cost Segregator. Okay. And to get to it, you go to the website, which is costsegregation.com. Okay. You look for the tab at the top, which says software. And when you get in there and you want to use the software, you can put in the promo code, which is Mentor 2025, all caps. Okay, Mentor 2025, all caps. And you'll get a 25% discount for first-time users of the software.
Okay, that's pretty cool. And if you're watching this and you don't recognize my smiling face, you can reach us at ronlegrand.com. But you might want to go to ronlegrand.com/terms, and you'll learn all about how we buy and sell and buy and keep nice properties in a nice area. In fact, we just had another one come up yesterday in St. Augustine with nothing down because it doesn't have a lot of equity in it. And this is the time when you can get all the properties you want that have low equity in them because people just walk away from them or find somebody like us to buy them. And no, I don't know why they walk away, but I guess they got things going on in their life. So just within the past 2 months, we have gotten about 8 of those type of properties where you could just go take over the loan and hand you the keys. Especially good for anybody looking for their home. And in fact, what I'm thinking, I'm watching you, I'm thinking, how come I'm not buying these things and turning them into Airbnbs? So this is a very good message I'm getting here from watching him talk. All right. And I think that's exactly what I'm going to do with those ones that are very close on the payment now. They're not good on monthly cash flow unless you turn them into Airbnbs. So we get a free house that we get appreciation and depreciation on, cash flow, put people in them, and I mean, good, tremendous cash flow, usually 3 to 4 times what you get out of a single tenant, and it's all managed for you. So think about that when you think about him. Now, every time you buy a house, you do have to buy it. You can't lease it and go, you right?
That's right. Yeah. You don't want
to it. Yeah. Okay. I'm telling you, the people are begging you to take their property, begging you to buy their property. They don't have much equity in it. They ain't even got enough there to pay the realtor. And some of them have already been listed before we come in because they want too much so they could pay the realtor. So opportunity is endless out there, guys and gals. And just like this right here, very few people know what he said. Very few people understand what he said. And unfortunately, most of them won't do anything about it because they don't understand it clearly, but it's really very simple. Call him, tell him you want to report, and he'll take it from there. How do they reach you anyway? You got a phone number they can reach you?
Yeah, sure. My email address is probably the best. It's gian.pazzia@kbkg.com. So I'm going to spell that. It's Gian, G is in George, I-A-N is in Nancy, Pazzia, P is in Peter, A-Z-Z-I-A at kbkg.com. That's kingboykинggirl.com.
All right. Okay, guys, if we get through here and you got questions, send them to us at ask@ronlegrand.com, and we'll forward them to him and put him in touch with you. So, all right, well, I'm out of questions. So you're out of answers. So really, it's been enlightening to have you here with us today. And we'll probably have you on sometime in a not distant future as well, if anything changes in the cost seg marketplace. I get everything that I buy cost segged. And by the way, I pay more than you just told me that you'd do it for. So you're going to be the next one. All right. All right. Well, thanks a whole
Ron.
lot. Appreciate you taking time to work with us today.
Yeah, really appreciate it, Ron. This was an honor.
All right, y'all. Bye-bye. See you soon. Stay tuned. Watch for the emails so you can watch for these. And if you haven't joined the podcast yet, it's thementorpodcast.com. Thementorpodcast.com. Make sure you sign up. Then you have all the access to the hundreds of previous interviews that I've done all on the website. So thank you. Thank everybody for watching. See you soon.
That's all for this edition of the Mentor Podcast. To connect with Ron and learn how you can attain financial freedom, as well as up-to-date strategies to grow and protect your wealth based on today's discussion, go to www.connectwiththementor.com.